Bond and equity markets have fallen heavily year to date. They're having their worst start to a year for more than 50 years. Investors, meanwhile, are grappling with what to do next. The financial sector is one of the few sectors that benefit from higher interest rates. Bank margins increase as interest rates go up. We see 50 to 100% upside for a lot of financial stocks globally. Another potential idea is the subordinated debt of strong investment-grade issuers. Currently, subordinated credit is yielding close to 8%. But step back. What are we seeing today? Well, we're seeing a 4-decade high in inflation. A new monetary tightening cycle starting from all-time lows, and a growth shock to the economy from inflation. Pitted against those, we have close to full employment, very high savings balances at the corporate and household level, and governments continuing their fiscal giveaways to smooth the energy bills. Higher interest rates are good for banks, but less so for many other sectors. Higher interest rates allow banks to increase their margins, the first time in a decade for a lot of them. Earnings can increase 20 to 50% for every 100 bp increase in interest rates. And remember, interest rates have already risen by more than this in the US and the UK. So we're seeing earnings upgrades coming through. Of course, against this, we have a growth shock, a slowdown, and a potential recession. But to give an example, BNP, the French bank, saw its profits fall 13% in the COVID recession before bouncing back the following year. Hardly a calamity. A full-blown recession would see profits fall 10 to 20% for most banks in Europe. But that doesn't consider the positive increases from interest rates. Recession seems fully priced into both the equity and the credit markets at the moment in the financial sector, and is providing substantial opportunities for the investor. Having been relatively cautious at the beginning of the year, we see bank equity in the US, as well as subordinated financial credit in Europe, as likely to perform well in the coming 12 to 18 months. It is relatively rare that we like both equity and credit in financials. Today, we like both.